total cost reporting is coming to Canada. This is a great new development in the industry, bringing new requirements for transparency from both investment advisors and online discount brokers when it comes to the fees that you're paying for your investments. Today, we're diving into how your statements are about to look very different and what you need to know about the total cost of ETF ownership. Providers like BMO ETFs are working hard to keep fees competitive and transparent, but it starts with knowing what you're looking at. So stick with me and we'll show you exactly what's changing, how to read your new statement, and how to make every dollar work harder. As a quick reminder before we get started today, we're not providing any investment advice or recommendations. Today, as always, is about education and information. I'm excited to announce that Hélène Desbiens is back and joining me today, Vice Chair with BMO ETFs. We're going to talk all things ETF fees and total cost reporting. Hélène, thanks so much for being here today.
Thank you for welcoming me.
I want to kick things off with having you describe to us this new reform that we're calling CRM3, and more importantly, the new regulation around total cost reporting and what that means for investors.
Let's try to simplify this. So on January 1st, 2026, there was new regulation that came into effect requiring a clear dollar-based breakdown of the total cost of investing. This initiative, Aaron, known as the Total Cost Reporting, TCR, is part of a broader set of industry reforms under the Client Relationship Model Phase 3, what we call in the industry CRM3. The goal is really to enhance transparency, giving you as an investor a clearer view of the fees you pay and helping you to make more informed decisions about your financial future. So, what's changing for you? Three things: simple and standardized reporting, an easier cost comparison, and clarity across more products. So, starting in January 2027, your annual report on charges and compensation will have a new and standardized format that will make it easier to understand cost. Second, that's going to show the total dollar amount you pay for each investment, and that will let you easily compare costs across funds. This helps you more clearly understand the value of each investment in your portfolio.
I love it. More transparency is a good thing. So CRM2, we had around performance transparency. Now we've got fee transparency. So thanks for that overview, Hélène. Let's get into more of a ETF fee 101 discussion so we understand what makes up the fees that we're seeing. So let's start with the MER, probably the most common. Can you walk us through the MER, please?
So the management expense ratio, what we call the MER, this can be found in the fact sheet of the mutual funds, the ETF, or the SEC funds. And it represents the fund's fees and expense as a percentage. So management fee are a key part of the MER, and they do include the investment management fee for the fund's professional money management, and also the trailing commission service fee, compensating the firm that sold the fund to you.
And what about the TER? This is separate from the MER, something we maybe don't hear about as often. Can you explain this?
This exists, but I think we're going to hear more about this. So trading expense ratio, TER, again, it can be found in the fund facts of the ETF, mutual fund, or SEC fund. It represents the fund's trading cost as a percentage and includes brokerage commissions, custodian transaction fees, and other trading costs. And Aaron, this is really important. I think as a due diligence before investing, go on the ETF company or the mutual fund company website. First, look at the fact sheet of the ETF, mutual fund, or SEC fund that you want to invest in. You will find in the fact sheet key and important information like fund details, fund characteristics, portfolio strategy, fund performance, sector allocation, geographic allocation, risk rating. This is really important. And also on the fact sheet, you're going to find the maximum annual management fee and the management expense ratio. And
Thanks for that, Ellen. Now, I often get asked, why is there such a wide band of ETF fees in the market, with some costing, next to nothing and some with more seemingly high fees? So, can you explain that to us?
This is such a great question, Aaron. The vast majority of the $700 billion ETF industry are in low cost index ETF. But there's also other strategies that are more expensive because they have or strategy or process that takes more research and resources. As an example, factor, active, or alternative strategies. Those strategies are designed to capture alpha by targeting specific stock characteristics or investment approach that are expected to generate higher return. Though not all ETF funds cost the same. Again, Aaron, you need to do your due diligence. Some strategies are more expensive, and some asset class are also more expensive. So, versus index, factor, or active ETF, light or leverage ETF, crypto, cover call, or liquid alternative ETF have a higher average MER and TER. And the difference can also be wide from one company to another for the same type of strategy, specifically on the active side.
And I know you have some good data to share with us from the National Bank report that we're going to put up on screen here, but what do the numbers show in Canada in terms of fees?
So it's important, like I say, to look at the fact sheet, to look at all the documents, showcasing MER, TER, because there's a wide divergence in the same asset class. So, as an example, the developed market in Canada, all the ETF in that space, in that asset class, the average MER is 53 beeps. But when we look at TER, it goes from 2 beeps to 60 beeps. So we could see that the range can be huge. But if we go in others category, let's say cover call, the average MER is 77 beeps, but the TR could go from 15, to 3 beeps to 84 beeps. So again, you need to check the MER and the TR of your investment solution. In some cases, like daily leverage or inverse ETF, the average MER is 1.5, and the TR range can go from 14 beeps to 3%. So again, there, do your due diligence. Look at the MER, look at the TR of the ETF or the mutual funds that you want to purchase.
We know passive index based ETFs are typically low cost, but let's talk about sort of the active universe. Is it the same level of disparity, I guess, that we see in fees on the active fund side?
Exactly. Morningstar did a great study in November 2025. That's called the 2025 Canadian Fund Fee Study. And the biggest asset class in Canada is the balance fund, the asset allocation. There's $1 trillion invested in Canada in that asset class, and fees can vary a lot. When we think about the ETF portfolios like the ZCon, ZBAL, ZGRO, ZEQT that go in that space, when we look at the median, so, on 100 ETF, the ones that is exactly in the middle in terms of cost, fees go from 0.87 to 1.08%. That's the median. When I look at the fifth, more expensive in the space, that goes from 109 to 188. Compare that with the MER of our ETF portfolios, and they are in the first percentiles of low fees in that space. When you look at other category like US equity, the median is at 1.04. So again, there the median fees seems to be a bit higher than in the ETF industry on the active side. So again, whichever you're looking at buying an ETF, buying a mutual funds, this is really important that you look at the MER, that you look at the TR.
For sure. And there are other costs associated when we think about the total cost of ownership of an ETF that investors should be keeping an eye on. One of those is the bid ask spread. So, this is a good one to cover. Len, walk us through this.
So what does the spread actually tells us? Well, ETF liquidity, Aaron, is driven by the underlying securities, not the ETF own trading volume. So a tight bid-ask spread generally indicates that the underlying basket is also liquid. Even ETF with low daily volumes can be very liquid if their underlying assets are liquid. Most Canadian large cap equity ETF, therefore, show very tight spread, often just a few cents or small basis points because of their underlying securities. So the replication of the S&P TSX Composite, the US large cap, the Nasdaq, those are heavily traded, just a few cents, small basis points.
You're saying cents, you're saying basis points. We always hear bid ask spread quoted in those two different ways. What measures should investors be looking at? Cents or percentage points?
Well, I think we should go with what the Canadian ETF strategists tell us, and they say we should use percentage, basis points, not cents. Let's give an example. A spread quoted in cents is meaningless without considering the ETF price. So, as an example, a 2-cent spread on a $20 ETF, this is equal to 10 beeps. But an 8-cent spread on a $100 ETF is an 8 beep spread. So, despite 8 cents looking worse than 2 cents, the $100 ETF with an 8-cent spread is actually cheaper to trade than the 2-cent spreads on a $20 ETF. So, this is really important to look at the spread versus the ETF spread.
I think that is a very important misconception or
Mm.
something to get through is that you should definitely be looking at those percentage basis points and not just quoting it based off pennies. Um, Also important to understand is what behind the scenes can affect the bid ask spread. So walk us through some of these things.
Three main things I would say: liquidity of the underlying basket, currency and foreign market hours, and market condition, the volatility. So, if we go by the liquidity of the underlying basket, this is probably the most important factor, much more than trading volume. So, large cap US or Canadian equities, narrow spreads, small cap, as an example, or emerging equities, you're going to have wider spreads. Around currency and foreign market hours, ETF holding Europe, Asia may widen when those markets are closed. So often we say to the people, if they want to see, tighter spread, they should deal before 10:45 for buying Asian or European ETF. And finally, market condition. So sometimes spreads widen early at the open, like from 9:30 to 9:45 or from 3:45 to 4, or also during macro announcement.
For sure. Good things to keep an eye on. We're talking total cost of ownership for ETFs, so we got to talk about commission fees. What should investors think about there?
Well, it's pretty competitive, in Canada, the space has been really competitive. And now most discount brokerage offers zero commission ETF trading in some form, either on all ETF or select ETF or only on buy orders. So ask your discount broker about their commission fees on ETF trades.
So we're talking about keeping costs low. We know this is one of the few things we can really control in the investment space. But how important is it, and how big of a difference can it make in terms of us reaching our financial goals?
Aaron, time horizon helps accumulator and retirees. The FP Canada each year showcase what we call the concept of probability of survival. This is used when you have a financial plan. And usually, financial planner, the best practice when we do the plan, this is done with a 25% survival rate. So, as an example, someone young like you, so someone in their 20s, 30s, or 40 years old, have a 25% chance to live to at least 95 if you're a man, and 97-year-old if you're a woman. So in your case, you've got, if I can tell your age because you're so young, 57 years of time horizon in front of you. I'm a young boomers. I'm with the 50, 60, and 70 years old space, And those ladies and gentlemen, have a 25% chance of living to at least 94 years old for men and 96 years old for women. So I'm 62. So I've got a reasonable chance to live 32 years in front of me. So, you know what? Lower fees can really help you as an investor reach your goals sooner during accumulation, but that allows you also to keep more of your money during de-accumulation. So basically, Aaron, lower fees can help you reach your goals sooner. And BMO, with its low cost ETF offering, is there to help you reach your goals sooner in your accumulation phase, but also in the accumulation phase.
Okay, Ellen, you mentioned BMO ETFs, so talk to us a bit more about what BMO ETFs is doing to keep the costs down for investors.
BMO has a strong and robust low cost core ETF solution. When you look at the top 10 biggest ETF in Canada in terms of AUM, 4 BMO ETF are there. And BMO emphasize low cost equity, low cost fixed income, and also low cost asset allocation ETFs as the foundation and also the building blocks for investors' portfolio.
You mentioned asset allocation ETFs, so I got to stop you there because, we have done a lot more around cutting fees as of late. And in June, we just announced the reduction in the management fees on our most popular all in one asset allocation ETFs. So, very excited about this. The management fees are now just 15 basis points, making them, amongst the lowest cost options in the all in one space here in Canada. So that's really exciting. I also have a second very exciting announcement to share, and that is that this week we just press released more fee cuts. So as you love to say, we did it before and we're doing it again. So we've cut fees this week on ZGD and ZJG. This is our global gold and junior gold ETFs from 55 basis points to 40 basis points, and also on ZGB, which is our government bond ETF, to just 9 basis points. So I think this clearly demonstrates how committed we are to keeping costs low for investors.
I'm hearing that you've reduced costs from 30% for the gold one and 40% for the government bond.
Yeah, exactly. It's very
Wow, that's golden news for Canadian investors.
golden news. Yeah, with gold still so top of mind these days.
That's two great news for Canadian investors.
For sure. And I think a lot of these changing regulations are going to shine a new light on what investors are in fact paying. And so I think ETFs are really going to shine in the coming years as they have already. Thank you so much, Elaine, for joining us today. I really appreciate all the great insights. Hope to have you back soon. Thanks for watching today to our viewers, and we'll see you next time. Bye for now.